Unlock the secrets to smart home ownership and financial success with Home and Finance Insights. Whether you're a first-time buyer, seasoned homeowner, or real estate professional, this podcast delivers expert advice on home financing, insurance, tax strategies, wealth building, and more. Hosted by a mortgage and real estate pro who's been in the game for decades, we interview top industry experts to share actionable insights that help you protect, grow, and maximize your home investment.
One way to avoid the capital gains is when you sell that rental property is to buy another one and do a 1031 exchange.
Yeah, so 1031 is, just as Kevin said, an exchange. So what you're really doing, you're selling one property and buying another. And 1031 basically is the code section, the IRS code section 1031. That's why it's called 1031. That code section allows this process of what I'll describe as a tax-deferred exchange. So the way it works is you sell property A, and maybe it has a $300,000 gain on it that would normally be subject to taxes. But instead of just selling that property, taking the money and sticking it in your pocket, you basically direct the money to be sent to a purchase escrow, and you buy a new property under a certain rule set, and that can basically transfer the gain from property A over to property B, and you won't actually pay any tax on that gain until you eventually sell property B. One strategy that people use is they just continually kick the can down the road when they feel, hey, the economic conditions are right to sell this property. This is the market's telling me now's the time to sell, but I want to stay in real estate, so now I'm going to buy this other property. Now you have this huge built-in gain on property B, which if you sell that, you're going to pay not only the tax on property B's gain as an isolated thing, you're going to add the other gain to it. So now you've got an even larger gain to deal with. So people oftentimes will just continually kick the can down the road. It's unfortunate, but it's still a viable strategy that you do that until you pass away and you get a step up in basis. So your kids or your surviving spouse don't have to deal with the tax implications of it. So it's a bit of a morbid tax planning strategy, but based on our rules that we operate under, that's still viable. Not everybody can do that, but that's what 1031 allows. But there are very specific rules you have to follow to be able to capture that treatment. Number one of which is you've got to have what they call a qualified intermediary, or just commonly known as a 1031 company, involved in the transaction, and they've got to be involved early in the transaction. So the best way to do it is that even if you're just contemplating a 1031 transaction, even when you're starting to work with your agent, certainly when you go to open a escrow at a title company, you should inform all parties that you want to do this, even if you're not 100% sure. If you're just thinking you might want to do it and you want to leave that option open, let them know you want to get connected to a 1031 company if you don't already have one available. A lot of 1031 companies are connected business-wise to title companies. They're sort of like sister companies, so they usually have a connection there, or your real estate agent may have one. But bottom line is they got to be in place, and their role is they handle the money. In a 1031 exchange, when you sell, you do not get to touch the money. You can't have any of the money. The money goes to the 1031 company. They hold it until you buy the next property, and then they send it right to the title or the escrow process of the next property. They have to be there, and their role is vital if you want to get the tax benefits of it. Other considerations are timing. There's a 45-day rule and a 180-day rule. When you say, hey, I want to do an exchange, the closing date of the exchange becomes a very important date. And now, of course, you won't know when it's going to close exactly, but it means the clock is running both before escrow closes and after. Typically after. That's the more typical situation. So let's say you close on July 1st. You have 45 days from that date to identify properties that are potential candidates for your exchange, the new property you're going to buy. And then you have 180 days to close on one of those properties. If you meet both of those tests, you identified to the 1031 company your potentials in 45 days, and then within 180 days of closing, you closed on one, you can get full 100% tax deferred benefits from this type of transaction. Again, this one is really kind of a complicated area. There's lots of moving parts, but at its base, it's still a pretty simple concept. Instead of taking the money off the table, I'm reinvesting the money in another qualified property, and I'm using this specific process to do it. It's really a great, great tool for real estate investors who are interested in staying in real estate and not quite ready to pay the tax
Pay
burden
taxes on every
on that. Yeah.
property they sell and the
Yep.
gain on that. Is there a limit as to how many properties you can name during that 45-day period?
Yeah, a great, great question. So no, there is not. So you could sell a half a dozen rental properties through an exchange. And on the other side, you can buy a single rental property or a dozen rental properties. So there really isn't a limit on the number of properties. It's really on values and debt burdens. One of the keys is the way to think of it is you need to go up in value and debt to make it fully qualified. It's more complicated than that, but if you have that mindset, like if you're going from $1 million property to a $300,000 property, by default, you're going to pay tax on a bunch of the gain. You're still going to get to exclude some of the gain because you can have a partial 1031 exchange. But if you want to make it fully tax deferred, your mindset has to be, I got to go up in value and up in debt. It's really equal. That's really what you need to do. But the way to think of it is I'm going up in kind of purchasing power if I want the full exchange. The other thing to keep in mind is what types of real estate qualify for this. That's super important. Number one, you can't do this with your home. This is not for personal real estate. This is for rentals and other commercial real estate that's maybe used in a business or investment real estate. It doesn't have to be a rental, but it can't be something that you are living in, either part-time or full-time. It really has to be investment slash business use type of asset to call on both sides. So you can't exchange a rental for your new home, and you can't exchange your home for a new rental, right? There is a technique that people use where they go rental to rental, and then at some point in the future, even if it takes a while, they may eventually move into that home and make it their primary residence. But that really has to be like a separate consideration and really not tied to the original deal. So it's not permanent that it has to be a rental, but certainly when the deal is made, it's got to be rental to rental or investment to investment. Other considerations are what types of real estate. This can be, say, farmland to an apartment building. That qualifies. So it's called a like-kind exchange, but in the real estate world, like-kind is really any asset that qualifies as a rental or investment. So an office building to an apartment building, farmland to an office building, all of that, as long as there's qualified piece of real estate on both sides, it's a fabulous tool. And you are still in the real estate business, which, can get tiring, over the years and as you age. And, there are times when people are looking for a clean exit because of the effort it takes to be a real estate owner. But there is a way out there too. They go by different names, but we call them paper 1031 exchanges, where you, instead of buying an actual sort of physical piece of real estate that you own completely and control like you had before, you're now kind of an investor in a group with a group of other investors, and there's a professional real estate investment management company that kind of runs this portfolio, and they're buying a piece of real estate, and you're joining them as an investor into a piece of real estate. So you stay in the real estate game from an investment standpoint, but you exit from sort of a personal management of the property standpoint. So you're really now not part of management. You have no say in anything. You're just an investor, and you get a check once a month, and that's your involvement. It's not for everybody. It's a really complicated and challenging part of the investment world to do that. So you got to be real careful if you do that, but it's there. And for some people, it's a great path to follow. Again, they get tax deferral, but they get out of the day-to-day management of real estate, which certainly as you age can be a little draining.
That does affect how much you can write off of that investment as well. If there's some losses too, right? Passive versus active management.
Um, it does. Yeah. I mean, the idea, I think, with most of those investments is that you're really getting typically is taxable income, although they have depreciation on there too.
I'm familiar with passive versus active losses
Mhm.
that you can write off. How does
Mhm.
that work?
Active losses, in a general sense, you can write off in full. Passive losses are limited as far as what you can write off. So a lot of times it's nothing. You get zero write off. For rental real estate, there's a specific exception to that. Rental real estate is by default is considered a passive activity, but it's a special category of passive activity called active participation in rental real estate, which is a pretty low bar to achieve. So you can get some losses. You can get up to $25,000 in deductible losses on your tax return when you have rental real estate activity as opposed to other types of passive investments you may have. That itself can be pretty limited. As soon as your other income goes over 100,000, you start to lose some of that 25,000. Once you cross 150,000, it's gone. You could have rental real estate, have losses, in theory, allowed to take some of those losses, but because your income is too high, and that's a relatively low bar, you don't get any of those losses. What happens to them? They don't disappear. They roll over. They are counted as another opportunity to take some losses in the next year, and they'll just keep rolling over forever. They never expire. So if you hit a situation where you either have, say, income from that activity or other passive activities, those losses can come forward and reduce future taxable income, either rentals or other passive activity. And that can happen if, say, if your income goes down, or again, if you're just generating now some passive income, those losses automatically come in full to offset that. And then when you sell, you get all the losses against the sale in full. That whole process disappears upon sale, and all the losses kind of free up against the gain of the sale and against other rental real estate that year too. So that passive activity rules, again, pretty complicated, very unique to everybody's situation.
Right.
But if you're a rental real estate investor, it's something you should get familiar with and understand how it's going to impact you, because it's going to be a big part of your tax return, those passive activity loss rules and how they work.
Real estate professional tax status. What is that about?
Well, that's one way to convert those rental real estate losses into being fully allowed if you qualify as a so-called real estate professional. Just hearing that term reminds me again that real estate is the most unique asset in the entire tax code. There are more special rules revolving real estate than any other asset class in the tax code. So it makes it real complicated, right? Because there's just so many different little carve outs to help kind of the real estate industry that are built in the tax code. This is one of them. So a real estate pro is someone who spends a large part of their time in a real property activity. So that could be rental real estate. That can be construction, development of real estate. It can be real estate sales. So there are a number of activities that are deemed to be real property activities under the tax code. And if you spend enough time in those activities, you can declare yourself a real estate professional in your tax return, and that potentially converts those unused rental real estate losses that would have been unused in, say, a particular year into fully deductible real estate losses year after year. So again, it can be a really valuable part of a tax return, but it's only open to certain people who are already participating in some sort of real property business in some way. And they've got to be self-employed. So in other words, if someone is an employee at a contractor, so they're swinging a hammer all day or doing estimates or something, but they're an employee, it doesn't really count. So these have to be kind of self-employed activities. Unfortunately, mortgage brokers are specifically disqualified
Excluded.
from this situation. It can be a very valuable tax process, but it's a fairly unique set of circumstances to qualify.
Okay. Got it. What about short-term rentals and tax considerations for that?
The Airbnb question.
Yes.
So short-term rentals can be a fabulous tool for people to supplement their income and build real estate portfolios and all that good stuff. There is this situation tax-wise, as you described it, short-term rentals, that potentially opens up a tax favorable door for those types of rentals. I'll talk about why that is and then talk about the difficulty of doing that. So why that is, the best way to think of it is the hotel industry. So when you are in the hotel business, if you think about it, what you're doing is you are renting real estate to people on a very short-term basis, right? Your whole building is filled with very short-term rentals typically. And in that situation under the tax code, you're not in the rental real estate business. You're in a service business and you are taxed like every other business. So you don't file a rental schedule in your tax return. You just file a tax return, just like any other business that has nothing to do with real estate. What that means is potentially it's easier to claim losses on that activity. That's why people try to connect the short-term rental situation, say with a hotel, to Airbnb, which is also typically a very short-term rental period. So I'm a hotel, I can take losses, right, on my tax return. Well, an Airbnb short-term rental, maybe I can take losses and I can avoid that whole passive activity, limited loss thing, right? I can just treat it as a business because it's short-term and therefore captures the special tax ability to take losses, right? That's what people are trying to do. They're trying to claim losses that would otherwise be limited and open those up on a tax return. The challenge is there's more than one test. It's not just your average time of stay hits the short term. The second test is you've got to provide a pretty significant level of services. And if you think about a hotel, they're cleaning your room, they're providing other services beyond just renting you a box to sleep in, right? So it's a suite of services that are quite substantial that hotels are providing. And most Airbnbs do not do that, right? They don't reach that level of service. Sometimes there's no service, right? You don't even see anybody. You don't even interact with a human being sometimes the whole time you're there. So that's hard to meet. There are other tests that you could qualify, and it really is about the amount of time you spend on that activity, either in isolation or relative to other people spending time on that activity, like a property manager or a cleaning crew or something like that. So that bar is relatively difficult to hit. I'm not going to run through all the numbers on that today, but for sure, if that Airbnb activity is a remote activity for you, in other words, it's another state or not in your local area, so you're not really going there and doing much of the work on the property yourself, it's almost impossible that you would meet that test. You really have to be personally involved with that property to even come close to hitting those kinds of tests. So it is something that is worthy of consideration because a lot of Airbnbs have unique business models, right? Maybe they are providing a lot of services, or maybe this is one that's like, just the adjacent property to their home, or it's an ADU on their property, and there isn't a property manager and there isn't a cleaning crew. They're doing all the work themselves on a personal level. They might be able to pass that test to get this ability to claim losses. The caveat is it means if you have income, it's now not rental income, it's business income, potentially subject to self-employment tax, which is going to blow up the tax cost on it.
They might have to write it off on a Schedule C.
Yeah,
Which,
yeah, it's you file a Schedule C for those
okay.
activities. Yeah. Yeah, so it's difficult to hit that threshold for losses, and there is challenges if there are gains.
Yeah. That's another complicated part of the
It
tax
is.
code that you have to
It
understand.
is, and it is another area that we get asked about a lot because it's out there. It's like it's in the ether, right? You
Yeah.
hear it from Airbnb rental groups or online, like, oh, you get the short-term rental treatment. It's great, right? Well, it's very difficult to get that treatment.
Right.
Much more difficult than you would think if you just sort of stayed on the surface of it.
Yeah. I have quite a few clients that have taken a part of their home or an adjacent guest house, something like that, or an ADU, and they're running the whole thing. Their kids are cleaning the rooms and they're making all the reservations, they're handling all that, yet they may not know what those tax implications could be without talking to their CPA first.
Making it part of your tax planning, and just make sure you understand the exact answer for your unique situation.
Vacation homes and the mixed use tax rules on that. I've heard about it. I'm familiar with it, but that was from years ago. If you buy a vacation home, there can be some taxable write-offs, but there can be sometimes when you have none. Is that correct?
Yeah, well, so the way to think of it, I think, is if you are using the home part of the year for personal reasons, you're going there with your family, you're staying for a month or two, whatever the case may be. But when you're not there, you're renting it out, right? So the rental component can be quite significant relative to how much you use it. But when it comes time to the tax return, those types of rentals are treated a very specific way. And the answer basically is you can shelter the rental income on that activity through expenses of the property, mortgage interest, utilities, certainly any expenses that are direct to the rental, like the cleaning and maybe the rental agent or the property manager that's specific to the rental activity. Those deductions are allowed in full. And then for other expenses like property taxes, insurance, utilities, mortgage interest, those are allocated between what is personal and what is rental. So the key there is it's like a zero sum game on the rental side. At best, you're going to go to zero. So you're going to shelter, in other words, not pay tax on the rents that came in, because quite often there's enough expenses, even though some are only allocated over, there's enough expenses to wipe out the rental income, but you can't go beyond that. And it's different than, say, these passive activity rules. There's a special category of kind of unused vacation home expenses that just kind of roll around inside the property, and either you use them on the rental or you don't. They do roll over year to year. So each year is like a new test and a new formula. So if it loses money maybe in first couple of years and then it gains momentum and you start actually making money, you can use those prior year unused expenses to offset your income. But you're not going to ever be able to use those losses to offset any other income on your tax return. So it puts it in a sort of isolation bubble, and you can offset the rent from that property, and that's it. So it still can be great because you could have quite a good rents on a vacation property and you don't pay tax on those rents as long as there's enough expenses. And, a lot of times there is. So
Common tax mistakes. What do you see people do that they should really plan ahead and avoid some of these tax mistakes?
For for someone who's a W-2 wage earner, these days there's very few write-offs. It really is. A lot of the stuff is for business owners and homeowners or rental real estate investors. The key there is make sure, number one, every expense you have that you can logically connect to that activity or to that business, you should be considered for a write-off. So first of all, you want to be expansive in how you think of write-offs on that property. A classic example, which most people are familiar with, is just, your vehicle, right? And you're driving around. You're getting supplies for the rental, or you're, driving to the property manager's office to have a meeting with your accountant to talk about, those things. So there could be a mileage component that's allowed as a deduction, against a rental or against a business. Your cell phone, right? There's costs, your calls you're making specific to those activities. You can allocate a portion of that expense against those activities. It's funny. I mean, you want to be expansive and limited at the same time because you don't want to get carried away, right? You don't want to try to write off your whole life on those things, but you certainly want to think about the elements of your life that are you're partly doing those things or partly spending that money specifically for that activity. And you want to give yourself an allocation of those expenses against that activity. Record keeping is a big deal. Documentation is key on taxes. If you're winging it and you're just sort of doing it from memory and kind of estimating, the odds are you're going to miss something and you're going to put yourself in a bad position, both with preparing the return, working with a tax advisor, potentially being audited from the IRS. You're just going to be in a bad place in all those situations. So keeping good records. We often get questions like, which program should I use? How should I do it? What's the best way to do it? There really is no best way to do it. You want to find a method that works for you, and you want it to be thorough and complete and organized and understandable by another person. As long as you get there, it could be handwritten. We have rental activities all the time where the records we get for the tax return are just handwritten summaries of the expenses and income they had for the year. And that's fine. That works for them. They know it's accurate. They've gathered all the data. They just have a very basic kind of old school accounting process, and that's fine. It doesn't have to be complicated. It doesn't have to be sophisticated. It just needs to be consistent and organized and complete and understandable by another party. And that, again, will make everybody's life a lot easier. And it gives an opportunity with that written record to go, okay, what's missing, right? What did we not capture here that we should? Helps quite a bit if you're organized.
And I understand that mainly applies to people that are in business for themselves or have business type deductions. But the W-2 employee that doesn't have any rental properties, what are the items that they should make sure that they save records for? Obviously, they're going to get the mortgage interest 1098 in the mail at the end of the year. They're going to get the property taxes figured out for them ahead of time. But other things like medical bills, do they need to save every?
It's a toss up. I mean, again, medical has to jump through several hoops to turn into an actual deduction. So is it worth it to capture all that stuff, work it into your tax return and see if you get a deduction? I mean, my answer to that is yeah, sure. It's probably better to do that and not get a deduction than not do it and miss one that you could have gotten. The flip side of this, again, I said we're really talking about the feds, but in particular to this topic, California still has a relatively low standard deduction number. So for many of our clients who are standard deduction for the feds, they're still itemizing for California, which means it's still in their interest to gather medical expenses and charitable donations and car tax numbers and all that stuff, because you still can get a tax benefit even if you've thin standard deduction for the feds and you're not even close. You can still get a write-off in California. Our preference is to have people gather that and provide it. And that way we're sure we're not missing something along the way. Like maybe they moved, right? And they made a huge donation of stuff to Goodwill or some agency or something. And that's the only time they're going to have something like that. And so maybe that does give them a tax write-off if we have the rest of the story. So I think it's still in people's interest to gather that stuff and provide it or work it into their tax return to see if we get a write-off. If we don't, it's kind of like no harm, no foul. Maybe I wasted some time, but it wasn't wasted because it could have gotten me, a write-off. The other thing for wage earners, a lot of it is tied to their employer now, right? So if there's a tax deductible retirement plan or 401k plan or something, and that's a tax write-off right off the top. And so the first step was we try to get people to maximize that. If you can maximize that, then we'll talk about other things. Maybe IRAs are still a possibility. Health savings accounts, we think, are hugely beneficial for the tax-paying public. Not enough people have them. We recommend them all the time. And we just think they're a great tool. Everybody's paying too much for healthcare. This health savings accounts, HSAs, give you a way to get some subsidy from the government for those healthcare costs because it creates a write-off in your tax return. So those I think are important considerations, for folks who don't have a business. It's those kind of tax-saving programs that are out there. They can be very beneficial. A lot of people just aren't aware of them or just aren't participating in them when they could be and should be. We did have the big tax bill.
So, George, can you comment on the new tax bill that was signed recently? How does that impact people in general?
Yeah, I'll break it into a couple different components. So, number one, I think the most important thing to remember about this tax bill is even though it is a very significant piece of tax legislation, in large measure, what it did was kept the status quo. The tax rules changed significantly in 2018. Almost all of those rules were set to expire automatically at the end of this year. And that just has to do with federal budget rules and so forth. So what this law did primarily was extend those 2018 tax changes into the future. Things like that standard deduction, business expenses for employees. There's many other things involved there. That was really the big part of the bill. The new stuff that is significant for people potentially is, again, solar credit disappears, right? EV credit, vehicle credit for electric vehicles and the like disappears, right? So all that's gone. That's going to have a big impact on people. And these new write-offs that are available for tip income, overtime income, and also for seniors, those are all new. The senior one, there already was a write-off for them. Now it's just a larger number. It goes from 2,000 to 6,000. That's pretty straightforward. The overtime rules and tip rules, especially tips, but overtime too, it's still unwritten a little bit exactly how it's going to work. So, and that's fairly typical for something new that we haven't really experienced before. The system has not had to deal with that before in the way it's going to have to deal with it now. So the rules really have to be written. So Congress makes the law, right? President signs the law. IRS now is charged with what is the exact detailed rule set for how that is going to work. What do the employer and employees need to do in their payroll systems to identify those types of income so the write-off can be claimed, right? So there's a whole process that needs to be written. And in particular on tips, there's a part of the law says it's only for industries that typically have tips as part of their process. And there's going to be a list developed by the IRS that says these are the qualified industries. And if you're not in one of those industries or one of those professions, you don't get a tip deduction, even if you get tips. And they're doing that because they want to avoid people trying to game the system, right? We're now like, Evan, if I provide you tax services, my fee is $10, but I would really request a tip of $1,000, right? So that I can get this tip write-off. So they're trying to avoid situations by like that. And the
Right.
way they do that is they make the rule set rather restrictive, or as restrictive as it needs to be, to prevent, or at least attempt to prevent, kind of game playing. So tip and overtime is going to be very interesting. Number one, from an employer standpoint, there's not a whole lot of impact. So tip wages initially at the employer-employee level, at the W-2 level, are going to be taxed exactly the same as they always have been. No change. The change will be the identification of tips on the W-2. So there'll be a new box or maybe a modified box, because there is already some information about tips on there, but there'll be like kind of like a qualified tips line that then that employee will then use to claim a write-off on his 1040 income taxes. So the cost of Social Security taxes, Medicare taxes, basically payroll taxes, right? The additional taxes you pay for being a wage earner,
Mhm.
those are still in place. So there's still Social Security and Medicare taxes on tips, unchanged, the
Okay.
employee and the employer. And that's true for overtime also. Social Security, Medicare tax applies, employer, employee doesn't change at all. What changes, again, is the employee potentially can claim a write-off for some or all of their tips on their 1040 if certain conditions are met. Also income tested. The more your income, the less or zero you get as a write-off potentially. Overtime, same way. There'll be a special box on the W-2 that says qualified overtime. It's tied to Federal Labor Standards Act overtime, so it's got to be like sort of official qualified overtime. That'll be identified in the W-2. The employee then on their 1040 will have the ability to potentially claim an extra write-off against their income tax on their 1040. Those are two new things that the system has not dealt with before. So the rules have to be written from scratch, and this process is going to take place to get to the point where people understand how does it work and what am I supposed to do. But for certain taxpayers, those things can potentially have a really big impact.
Wow.
Yeah.
There's just so much complication to this. I don't know how you keep up.
It
It's a
is. I
lot.
mean, there's, computers help a lot, right?
True.
They do help us. And it's crazy in a way that I say that because computers themselves allow Congress to create super complicated tax laws because they know computer programs and the software writers can handle it, right?
Right.
If we were back in the days of doing tax returns by hand, none of this stuff would be in the tax code. It would have to be more simplified to be able to do this. So the
Yeah.
computers both help, right? But they also create this ability to have a hyper complicated system. And that's what we have.
That is
Unfortunately,
exactly
it gets
right.
more and more complicated all the time.
Well, George, this has been incredibly helpful. Thank you for breaking this down for my listeners, and we got a lot out of this. So for anybody listening, if this episode was useful, be sure to subscribe, share, and follow us for more on home and finance insights. If you have any questions about your taxes and you want to explore more, I will have George's contact info in the show description. And if you have any questions for me, please feel free to reach out to me directly. Thanks for listening. Thanks, George. We'll see
All
you
right.
next time.
Thank you, Kevin. Be
All right,
safe
man.
out there, everybody.
All right. See ya.
Thank you for listening to another episode of Home and Finance Insights. If you found this information beneficial, please like, comment, share, and subscribe so that you won't miss future episodes. Kevin Mathews, NMLS number 234253. California DRE license number 00884-691. Kevin can be reached at kevinmatthews.com or email kevinmatthews@empirehomeloans.com. Empire Home Loans, Inc., NMLS number 1839243. California DRE license number 02086593. Refer to nmlsconsumeraccess.org to see additional licensing information. The corporate office address is 4401 Hazel Avenue, Suite 225, Fair Oaks, California 95628. This communication is for informational purposes only. This is not a commitment to lend. All programs are subject to change or cancellation at any time and without notice. Empire Home Loans, Inc. supports equal housing opportunity.